Welcome to the Deep Dive. Today we're digging into Rocky Mountain Chocolate Factory, RMCF, specifically their fiscal Q2 2026 earnings call.
Yeah, this one was interesting. You've got management pushing this transformation story pretty hard.
But the numbers maybe tell a different tale. That's what we're here to unpack.
Exactly. The call was pre-market, 9 a.m. Eastern, and, well, the market reacted fast. The stock dropped about 7% right off the bat.
Ouch. Okay, so let's set the scene. Management says they're moving past planning into, quote, transformational performance. Disciplined execution, that's the message.
Right. But the question is, does that square with the financials they actually presented? Let's see.
Okay, start us off. What were the headline numbers?
Well, there was one bright spot, sort of. Revenue came in at $6.8 million.
Which is up, right?
Yeah, up 6.9% compared to last year. So, seeing top line growth, especially now, that's usually positive.
Usually, but I sense a but coming.
Oh, yeah, a big one. Because that's really where the good news stopped for investors. They looked straight past the revenue to the bottom line.
And it wasn't pretty.
Not at all. GAAP EPS, that's earnings per share based on standard accounting principles, was a loss of 9 cents per share. Negative others in 9 cents.
Okay, a loss. But what really spooked the market, was it that gross profit number?
Bingo. That was the killer metric. Total product and retail gross profit.
Yeah.
It didn't just shrink, it flipped entirely.
Flipped how?
Last year, they made $0.6 million in gross profit on products and retail. This quarter, a loss of $0.03 million. Negative territory.
Wow. So even with more sales, they actually lost money on the stuff they sold.
Precisely. And while overall costs and expenses were basically flat year over year, around $7.3 million, that didn't matter because the profit engine itself stalled out. Any operational savings were just swallowed whole by this margin collapse.
So management's talking execution, but the core profitability just isn't there right now.
That's the tension. They're trying to sell the future. They pointed to specific things like the new VP of operations.
What about them?
Well, they said this VP immediately put strategies in place. Practical stuff like cutting overtime pay, reducing scrap and waste at the factory.
Okay, that sounds sensible. Low-hanging fruit.
It is. And they also talked logistics improvements, moving packaging back to Durango, getting warehouse space in Albuquerque.
Albuquerque, why there?
Cuts transit time to the factory from 7 hours down to just 3, they said. That saves on transport costs, obviously.
Right, makes sense.
But it's also about getting more of their own Durango-made products into stores faster. That's where the better margins are supposed to be.
Okay, so there are operational tweaks happening, but how does that stack up against, say, the cash situation? That looked a bit scary.
Yeah, the balance sheet adds another layer of concern. Cash is down to $2.1 million.
$2 million? Wasn't it like $7 million not that long ago?
It was, earlier in the fiscal year. That's a pretty significant burn.
And how are they funding things? More debt.
Yep. Total debt climbed to $7.8 million. They added $1.8 million in new borrowing just this quarter.
Okay, borrowing isn't unusual, but what are the terms?
Uh-oh, that's the kicker. Both new chunks of debt carry a 12% interest rate.
12%? Oof, that's not cheap money. That puts a lot of pressure on them.
It really does. When they were asked about the cash burn, management basically said, look, Q1 and Q2 are always slow. That's why we borrowed.
But did they say the burn stops?
They were pretty firm. They stated they do not expect to keep burning cash over the next 12 months. That's the guidance the market has to cling to.
Okay, so high-stakes execution needed. Let's pivot to growth. They sounded bullish there, right? Strongest development pipeline in years.
They did. And they tied the franchise interest to a couple of key things. First, it's a relatively low labor model compared to, say, fast food.
Right.
That's huge right now.
Good point. Labor costs are tough everywhere. What else?
Second, the new store design. It apparently has clearer, lower build-out costs, so they can give potential franchisees a much better picture of the return on investment, the ROI.
And is it working? Are people signing up?
Seems like it. They announced new franchise deals for Palladio Mall in California, Jersey Shore Premium Outlets in New Jersey.
Okay, those are decent locations.
And they said they're in final talks for a spot in Houston Hobby Airport. High traffic potential there.
Interesting. Now, you mentioned something about company-owned stores being part of the strategy, too. That seems counterintuitive for a franchisor.
It does, but there's a logic to it. They bought the Camarillo, California store. It's been around a long time.
How much did they pay?
Get this, $165,000.
For a whole store. What were its sales?
Last year, that single store did $700,000 in revenue.
Whoa. Okay, that multiple is tiny.
Right. And management's point is, if we want to be a great franchisor, we need to be great operators ourselves. Prove it works.
So these company stores, they have 3 now: Durango, Corpus Christi, and Camarillo.
Correct. They're using them as labs, basically, testing new products, new layouts, new experiences before rolling them out to franchisees.
That actually makes a lot of sense. De-risks it for the franchisees.
And they claim it's working. They remodeled the Corpus Christi store. Immediate sales bump. They even had their busiest single day ever right after the remodel. That kind of data is powerful when recruiting new franchisees.
Okay, so this ties into the whole rebrand effort they talked about.
Exactly. New logo, new packaging they mentioned. It's modular so they can roll out samplers faster. Even updated the mascot, Truffles the bear.
Right, the bear. And the big showcase for all this is meant to be that Chicago store.
Yeah, the State Street flagship. Still aiming for an opening around the holidays. That's supposed to be the template for future remodels across the system in 2026.
And what about digital? Are they modernizing there too?
Trying to. A new loyalty program is coming. Personalized, mobile-friendly, planned for just after the new year.
Okay, and delivery.
They're pushing franchisees towards DoorDash storefront. Apparently, the economics are better for the store owner that way. Plus, it gets them wider reach.
All right, so lots of moving parts operationally and strategically. But let's bring it back to the big cloud hanging over everything: cocoa prices.
Ah, yes. The cocoa conundrum. This is really the core issue hitting that gross margin right now.
Prices spiked like crazy earlier, hit over $10,000 a ton, right? Where are they now?
They've fallen back a lot, thankfully,
Oh.
but still elevated. On the call, management mentioned a price around $5,800 per metric ton. Still historically high.
So still expensive, but falling prices should help their margins eventually.
Eventually, yes. But here's the critical timing issue. Management admitted they locked in some supply earlier at around $8,000 a ton.
8,000. Ouch, when futures were much higher.
Seems like it. And since chocolate is like 40% of their raw material cost.
They're still paying those peak prices even though the market has dropped.
Exactly. That expensive $8,000 cocoa is what's flowing through their production now and crushing the margins this quarter.
So even if futures stay around $5,800, it'll take time for that cheaper cocoa to actually hit their bottom line.
Correct. Industry folks are saying retail chocolate prices might stay high right through Halloween next year, 2025. There's a significant lag. RMCF has to survive until they burn through the expensive stuff.
Okay, that context is crucial. So looking ahead, say 3-6 months, what are the key things for you to watch?
Definitely holiday season performance. That's huge for them.
Ah.
Then the opening of that Chicago flagship.
And the digital stuff.
Yeah, the loyalty program rollout, and obviously just tracking where cocoa futures go and any news out of West Africa on supply. The story only shifts from surviving to thriving if that gross margin recovers.
Right. Which brings us nicely to our next segment.
It's time for This is not financial advice.
Okay, time for the wild, maybe not so wild trade idea.
Let's hear it. The market's clearly pessimistic right now.
Totally. They're fixated on the gross margin loss, the debt. Understandable.
Yeah.
But I think they might be missing a different angle.
Which is?
The pitch is long RMCF, not based on near-term chocolate profits, but as a hidden asset play.
An asset play.
Look at that Camarillo deal. They used debt, yes, expensive 12% debt, but they bought a $700K revenue store for $165K. That's less than 0.25x sales.
Okay, very cheap acquisition multiple.
So the thesis is management is strategically using this debt to snap up proven high-revenue stores on the cheap. They run them, prove out the new concept like they did in Corpus Christi, hitting maybe 15-20% pre-tax margins, which they say is possible at the retail level.
Right. Establish a track record.
Exactly. Then potentially they bundle these proven, profitable, company-owned stores into attractive clusters and flip those clusters to sophisticated multi-unit franchisees.
So acquire low, prove the model, then sell higher to a franchise group.
Precisely. Sell them at a much higher enterprise value multiple than what RMCF currently trades at as a struggling microcap. The value creation comes from that asset conversion, not just selling chocolate day to day. The market's ignoring this potential asset accumulation and flip strategy.
That's definitely plausible if audacious. It relies heavily on them executing that flip before the 12% interest really bites hard.
It's absolutely leveraged to execution. High risk, potentially high reward if they pull it off.
Okay, so wrapping this up, the core tension for you, the listener, is pretty stark, isn't it?
Yeah, it really is.
Can the company survive the short-term cash crunch and this awful gross margin pressure long enough for the store upgrades, the franchise growth, and eventually cheaper cocoa costs to actually kick in and save the day?
That's the multi-million-dollar question. So the key takeaways from this deep dive: you've got that brutal, persistent gross margin pressure fighting against what management claims is their strongest franchise pipeline in years, potentially backed by this sneaky asset acquisition strategy.
Keep a close eye on the holiday numbers. That'll be the first big reality check.
Absolutely. Thanks for joining us for this analysis.